Okay. Um, Welcome to take two for our discussion of what's currently impacting global oil markets and energy markets more generally. To be honest with you, we're going to be focused heavily here on petroleum. But I'm joined again for this discussion by Mark Finley and Jim Crane. And I think what we're going to do is very similar to the way we approached this last time. We're going to begin with a few opening remarks from Mark, and then we'll pass it over to Jim. And if you have questions, please feel free to submit those through the chat, and we will address those as they come through. So with that, Mark, I'm going to pass it over to you.
Great. Thank you, Ken, and welcome to everyone who's joining us today. I hope you're keeping all safe and well. I'm going to pick up where we left off and really focus my remarks on what we did, what's happened since we last met 2 weeks ago. Before we do, though, I just wanted to flag that today is the 50th anniversary of the safe return of the Apollo 13 crew. So, cheers to all the heroes who got them home. And cheers to all the heroes who will get us through this too, because just like then, it may feel like Houston, we have a problem, but we will get through it. So where have we come to in the last 2 weeks? The bottom line is that we've seen some big production cuts agreed, but they may not be big enough. Hopefully, however, they can avoid or delay another big downward move in oil prices if the cuts are able to keep global inventories from overflowing and hitting capacity. Early returns aren't great. Since the announcement, prices have been falling again, especially here in the US. WTI today is about $18 a barrel. Brent on the international market is about 28. That's already an indication that we're seeing significant limitations in the US system. Not only do we see a huge differential between the US and international benchmarks, we also see a huge time spread within the US benchmark. So WTI is 18 bucks on the front month today. 2 months out, it's $29. And in the physical market, we're already seeing single digit pricing for a number of mid-continent crudes here in the US and in Canada. So let me turn to the news on the supply side. The biggest coordinated production cuts the world has ever seen, announced OPEC and its partners in the bigger OPEC Plus agreement or grouping, including Russia, have come together and agreed on cuts of 9.7 million barrels a day for May and June, moderating to about 7.5 million barrels a day thereafter and through the end of the year, and continuing the cuts on an even more moderated basis all the way through April of 22. And moreover, there are rumors that Saudi Arabia and its GCC counterparts within OPEC have also offered to voluntarily cut an additional 2 million barrels a day on their own on top of that. In addition, what's really fascinating about this landmark deal is that it brings in a much broader group. Under the aegis of the Group of 20 nations and the International Energy Agency, there were additional endorsements, shall we say, of this agreement. Not a lot of specifics, although rumor has it that countries in that broader group, including the US, Canada, and Brazil, are expected to contribute about 4 million barrels a day of production cuts. And there is also speculation that member countries of the International Energy Agency, plus China and India, will also purchase crude oil for their strategic stockpiles. It has been asserted by people including President Trump that the total interventions will total closer to 20 million barrels per day. Let me break this down in a bit more detail. This agreement came about with a little bit of something for everybody. For Saudi Arabia and Russia, who were the ones that started the price war, it was a face-saving way to get out. With President Trump having taken the lead in bringing the parties together, and by broadening the group to include this bigger group of countries inside the Group of 20 and the IEA. President Trump gets to, be the deal maker, while the U.S. commitment looks to be, so far, mainly around what the market is already, adjusting to, and we'll come back to that. Although there is no firm contribution, the U.S. Energy Department has analyzed that in current circumstances, domestic production could fall by as much as 2 million barrels a day by the end of this year. And that's exactly the number that the U.S. Energy Secretary has been quoting in terms of the U.S. engagement. This, of course, bolsters the president's standing as a deal maker, and especially with oil states heading into an election season. Other key players. Mexico was the only country in the group of the original OPEC plus group to get an exception from the 23% reduction. So the president of Mexico, gets to have credit for having taken a tough line and getting spotlight, conversations with U.S., Russian, and Saudi leaders. The Group of 20 and the International Energy Agency get a seat at the table, even though they weren't asked to commit on paper to any formal heavy lifting. I think personally, it's a really shocking development that a group like the International Energy Agency, which is dedicated to looking after the interests of consumers around the world, has taken such an aggressive role in promoting cooperative production cuts to support oil prices. Everybody else gets what they were hoping for, at least they were hoping for getting a bottom to oil prices, although we'll see. There's plenty of things to be concerned about as how this agreement holds together. As I mentioned, the US and the broader group of countries didn't make any formal commitments beyond letting market forces work. There seem to be some questions about the baseline of production attributed to Russia and Saudi Arabia in the deal. There's the obviously bad precedent of giving an exception to one country, Mexico. And given the size of the cuts and the number of participants, there's obvious questions around the potential for compliance with these agreements. Will people actually obey the production cuts that they've agreed to? And of course, even with all of that, as we will see shortly, even with the biggest cuts in history, they're small compared to the current estimates of the size of global demand destruction. Again, huge cuts, but not as big as the loss of demand that we're seeing at the moment. Here in the US, the supply response is already visible. The US rig count has fallen by 245 in 5 weeks. That's 36%, to the lowest level since 2016. In the last down cycle for oil prices, it took twice as long to get that many rigs off the market and 3 times as long to get that percentage of rigs off the market. So the adjustment is already much more rapid. Weekly data from the U.S. Energy Department shows that U.S. crude oil production has fallen by 800,000 barrels per day just in the last 4 weeks. This week, the regulator in North Dakota said that since the beginning of March, 4,600 wells had been shut in, accounting for a reduction of 260,000 barrels a day of production. ConocoPhillips also announced this week that it had shut in the equivalent of 200,000 barrels a day of combined oil and gas production. And what doesn't get much noticed is that in the official data, we also see that biofuel supply as part of the energy system is down by 500,000 barrels per day in the last couple of weeks as gasoline consumption, into which it is blended, has been crashing. The scope of the demand destruction is becoming more clear. The IEA this week estimated that global oil demand is going to fall by 29 million barrels per day in April. And it expects the average annual decline for all of this year to be over 9 million barrels a day. That is almost 4 times the size of the previous record oil demand decline. The previous record was 2.6 million barrels a day of a decline in 1980. Here in the US, weekly demand has fallen by 8 million barrels a day, or 37% since the first week in March. On the weekly data, it's the lowest on record, with data going back to 1990. Gasoline demand is down by 48%. Jet fuel demand is down by 70%. Diesel is slightly better. It's only down by 1/3. And on the back of this, inventories are soaring. Total inventories have grown by about 70 million barrels a day since the beginning of March, largely in crude oil. Commercial crude oil inventories in the United States are 30 million barrels below their previous record of March 2017, but filling fast. Gasoline record storage is at all-time record levels. By the way, there is also, the U.S. Energy Department has begun, to their immense credit, reporting not only inventories, but also capacity. The U.S. Energy Department reports that there is 280 million barrels of spare storage capacity for crude oil, but that's very untested. And I don't have a high degree of confidence in that being the true figure. There is also, of course, 80 million barrels of capacity unused in the U.S. strategic stockpile as well. So, biggest uncertainties, and let me wrap up here. Remember, this is a demand shock. So the biggest uncertainty is, where does demand go from here? How deep and how long will the COVID-19 response be, both in terms of its impact on the economy and on the policy response? And we're already seeing policy, pressures to begin to reopen the economy and debates around the trade-off of closing in, sheltering in place versus damaging the economy. So are we going to look at a V-shaped recovery, a very quick recovery in oil demand? Will it be more of a U-shape, a slower shape in demand? Or are we looking at a situation with a durable impact of demand? We don't know yet, and we'll have to watch and see. On the supply side, I would say the key uncertainties remain, can OPEC implement production cuts big enough and quickly enough to avoid filling up inventories? And how quickly will the U.S. response ratchet up? Let me pause there and turn it back over.
Great, thanks, Mark. And to a point that was actually raised by one of the viewers, some of the data that Mark was actually just commenting on are in tables and emails that we've been sharing back and forth, and quite frankly, a lot of it's publicly available. But we are periodically publishing issue briefs and short posts on our Forbes spot that highlights a lot of this stuff. So, be sure you keep an eye there, because there was a question about whether or not we could publish these in a table so that it can be studied. Certainly that's doable.
And I would just note, Ken, that all of the data I've quoted is publicly available information. It's most of it is from the U.S. Energy Department's website, EIA.gov, and a bit quoted from the International Energy Agency, IEA.org.
Right. Thanks, Mark. So, Jim, I'm going to pass it over to you now.
All right. Well, hello, everybody. I hope you can all hear me. So I want to sort of steer the conversation a little bit towards the U.S.-Saudi relationship, and then I'll finish up by taking a quick look at Iran. So the U.S.-Saudi relationship, I think lately it's pretty safe to say that that it's in flux. Sorry, I'm getting a question here. Can you guys hear me? You can hear me okay? Okay, sorry. I'm getting some folks are having trouble hearing. So the U.S.-Saudi relationship, I think it's pretty clear that it's been in flux lately. Pretty clear that the Saudis need the U.S. They need the hard security protection that we provide to the tune of $100 billion a year. They really benefit from diplomatic backing that we provide, especially over the unfortunate events like the Jamal Khashoggi murder, and through the Saudi-led war in Yemen that's been so devastating. And they also benefit from this economic partnership, two-way investment, but that includes lots of big contracts in Saudi Arabia for the U.S. U.S. companies like Bechtel building the Riyadh Metro. But it seems that the U.S. These days it seems to need Saudi Arabia less and less. The U.S. has been approaching self-sufficiency in energy and in oil. Imports of Saudi crude have been dropping, although it looks like they're about to leap up here temporarily this month and next month. I think the U.S. still feels that Saudi spare production capacity that we spoke about in the last meeting is still really useful, but probably not quite as crucial as it was given the the oversupplied market that we're in now. So we're seeing this newly nationalist U.S. foreign policy popping up now as one of the results of this. Now, some of this is is Trump and his sort of maverick foreign policy, but some of this is around this stronger feeling that we're less dependent on the Middle East and on oil producing countries. We're seeing this material manifest itself in that sanctions. The U.S. is now able to slap sanctions on just about anybody and get away with it, including oil producing countries that might have been immune from this in the past. You've seen that this recent letter from the oil state Republican senators, even suggesting sanctions on Saudi Arabia, and I'll come back to that letter in a minute. But I think there's been little recognition that Saudi and OPEC constraints on production were really helping to drive these changes that we're seeing in this relationship. So, as I spoke about in the last meeting, Saudis since 2016, alongside OPEC and OPEC Plus members, have been cutting oil productions. These cuts really gave the U.S. industry market signals it needed to ramp up production, and it did so massively by almost 4.5 million barrels a day. Now, those constraints on production also helped oil states, and including Saudi Arabia, and if they fund their government budgets, but they also contributed to some pretty negative effects from the Saudi perspective. So, you have this phenomenon of OPEC complaining that it's subsidizing a competitor, allowing the U.S. to free ride on those OPEC cuts. And that was allowing the U.S. to approach this long sought goal of energy independence. But it was also allowing the U.S. to become more independent in a foreign policy sense from Saudi Arabia. We heard the U.S. Energy Secretary this week saying that, quote, maybe we don't need you as much as we used to, in an interview I think it was in the Financial Times this week. So all these changing circumstances that we're seeing around the U.S.-Saudi relationship and around oil, they've brought about together, I think, another very important change. Okay, so in the past, you had the dominant voices in the U.S. encouraging this, free oil market with lower prices, right? That suddenly is no longer the case, or no longer only the case, right? So with the U.S. becoming the number one oil producer around the world, at least temporarily, the U.S. oil industry is now seen by the Trump administration around Washington as a domestic champion, okay, increasingly important and influential around Washington. And so we saw the president shifting his stance, okay, so from cheering low prices, as he did from the start of his administration, he suddenly began decrying low prices. And U.S. policymakers who, for the past 50 years have been beating up on OPEC with relish, did a complete 180. Now they want more OPEC and not less. You even saw in that same letter from those Republican senators a threat that if Saudi Arabia did not call off its price war, that they were going to demand that the U.S. bring home its troops and Patriot anti-missile batteries from Saudi Arabia. So pretty scary stuff if you're if you're a policymaker in the kingdom. And so I think this, the ironies of this were pretty apparent in a couple of interviews that the Saudi oil minister Prince Abdulaziz held last week. He made some remarks that made it sound like it was his surprising to him that the U.S. didn't want a free market any longer. He said the price war was, quote, a factual exercise in what a true free market would do when you have a crisis. Okay, and he criticized this so-called dogma of free marketeering, emanating from the U.S. So sort of noting wryly these changes. So what we saw, Saudi Arabia needing to preserve this U.S. friendship that it values so highly amid what it saw as a really surprising uproar over low prices this time around. They backed down and called off the price war. Now, of course, that was far from the only reason they did this. Price war, of course, was hurting them, hurting Russia, hurting everybody else, and a new agreement that wasn't possible in March, as we spoke about, suddenly was attainable, right, as Mark mentioned. So the Saudis led these OPEC cuts, but curiously did not push the U.S. to guarantee or join in any sort of a written way it joined these cuts along with OPEC and OPEC plus, more than what was happening, being driven out by the free market, right? So um, it seems that if there was a quid pro quo from the U.S. on this, it may have been just the preservation of the U.S. security umbrella that these the U.S. policymakers were threatening to withdraw. So once again, we've got the Saudis restraining the world's lowest cost oil production, and then they're thereby helping higher cost producers survive. Now, when demand resumes as this coronavirus pandemic starts to abate, we could see another shale revival like we saw in 2016. Now, if that happens this time around, I suspect that the Saudis and the Russians will try to avoid following the same playbook that they followed last time, that allowed shale to really sweep in to the #1 position on the back of those OPEC cuts. Now, are there ways, formal ways, that the Saudis and OPEC can get the U.S. to play along, maybe as an OPEC plus partner? With a few thousand oil companies in the U.S. that don't take their orders from the central state, probably not, but it's not impossible. I mean, the Texas Railroad Commission, as I hope Ken will mention, is deliberating this right now. Are there other concessions that the Saudis might seek in exchange, sort of another type of quid pro quo that they might hold over to try to get as part of a deal? Yeah, I think it's possible. They may ask us, to reaffirm our security umbrella, or if they see Iran getting close to a nuclear weapon, even extending the U.S. nuclear weapons umbrella over the Gulf, over the Gulf monarchies. I think a Saudi strategic rebalancing may be inevitable as oil demand continues to shift away from the OECD towards the developing world. Big oil exporters like Saudi Arabia are probably going to have to start rethinking these old oil for security ties. Developing countries are certainly going to buy their oil, but are they going to be able to make those same hard security commitments that the U.S. made, or Western European countries? No, I mean, they just do not have the military wherewithal to do that. So this model of defense that the Saudis have been relying on for so long looks like it's going to have to be rethought at some point, inevitably. Let me shift briefly to Iran and make a couple of quick remarks about that. We saw in the news this week, Iran seems to be attempting to return to normal life, such that it is. President Rouhani has not imposed a tough quarantine like some of the GCC countries have. Iran's government simply just does not have the cash to pay people to stay home from work. From what we're hearing, normal life is supposed to resume next week. This week, there was a resumption of some business as usual type disruptions in the Persian Gulf, with the Iran's hand in it. So Wednesday, 11 Iranian vessels were harassing a U.S. Navy task force, conducting all kinds of close maneuvers around the U.S. ships. The day before that, Tuesday, Iranian forces boarded and briefly seized a Hong Kong flagged tanker. Okay, neither of these incidents had any effect on the oil price, but I think they were kind of a shot across the bow, if you will, a warning that Iran's back, and that these grievances it has with the U.S. remain unresolved. They were put on hold while Iran was grappling with the coronavirus. But pretty soon they are going to be back on President Trump's plate fairly soon. In my opinion, this is a problem solely of the Trump administration's making by reneging on the nuclear deal and reimposing sanctions. So now we may see a second crisis alongside the coronavirus. And since Trump administration declined to relax sanctions, U.S. sanctions during Iran's outbreak, and is even talking about blocking an IMF relief package, there's no reason to expect that Iran would back down as the U.S. reaches its peak infection rate. So with that, I will hand it back to Ken. Thanks.
Great. Thanks, Jim. We actually did have one question come across, and I'm kind of going to do this more conversationally, but I wonder, both Jim, Mark, if you could address, because I know I've spoken with both of you about this and sort of gathered your thoughts on Saudi Arabia's recent billion-dollar investment in 3 European oil companies, and sort of what that might signal and what the driver for that might actually be. So I'll pass it back to the two of you, and feel free to answer that.
Yeah, I mean, I think Mark and I exchanged a couple of emails on this. It looked a little bit odd. I mean, if you're, the Saudi Arabia is allegedly in the throes of economic diversification, and so, you would, you know, this Vision 2030 plan is, by most, analyses that I've seen thus far, is way behind. They are not reaching most of their milestones that they were supposed to hit by 2020 in terms of diversifying their economy and opening up new business sectors. And here they are investing overseas in foreign oil companies, right? So it's a business that the economy is trying to diversify away from, or beyond anyway. So a little bit odd, but I mean, I think they saw, the Public Investment Fund is is led by a guy who's has a pretty well-known investor, Mr. Al Rumayyan, who probably saw a good deal and is looking for returns to help the Saudi budget. So I suspect it's probably around finding some way of supporting the Saudi budget in what looks like an extended downturn for oil.
What I'd add is, first I would echo Jim's comment about the stated objective earlier had been to use the Public Investment Fund as a way to help broaden and diversify the Saudi economy beyond oil. Investing in European oil companies, hard to see how that advances that ball. I mean, it's certainly being billed as a savvy investor buying low. And they've done the same, by the way, just in the last couple of weeks for a cruise line, as well as one of the English football/soccer teams, depending on which side of the Atlantic you're listening from. So I would also put the purchase of the European companies in the context of other recent purchases by the Saudi Sovereign Wealth Fund.
Great. All right. So there are a few questions sort of coming in that are really aimed at where I was going to steer the conversation next anyway, in particular around the outlook for the U.S. Shale sector in particular, but oil markets more generally. Thinking about in the near term, what role the Strategic Petroleum Reserve might actually play. I know there's been a lot of discussion about that at the federal government level. Of course, there was I think it was a $3 billion proposal that was ultimately shot down in the $2 trillion fiscal support package that was passed to allow the DOE to purchase oil for injection into the SPR. But there's been subsequent proposals about leasing space, et cetera, et cetera. So I wonder if you could, and maybe Mark, this is more directed to you, comment on what role that could play in the short-term balance. And then once you do that, I'm going to come back to a couple of other issues related to the outlook.
Right. Every little bit helps. The U.S. SPR, there's logistical connections about how much it can take and how quickly, and how you would get the crude to the SPR loading facilities. The Energy Department says that its spare capacity is about 80 million barrels. Last week, U.S. crude oil inventories built by 19 million barrels. So that would buy 4 weeks, at that rate of fill. Not a permanent fix, but again, we're in that mode where every little bit, can help. As you noted, Ken, the efforts to purchase oil for the SPR weren't funded in the latest stimulus or the most recent stimulus. So, now the conversation is around allowing companies to store oil, and there is provisions for that within the SPR's governing legislation.
Right. Yeah. I mean, just something we kicked around a little bit. I mean, aside from the optics of a bailout for the oil industry, which I think is one of the things that was sort of thrown out as why that $3 billion provision was not included. economically, it kind of makes sense to buy low and sell high, right? So one wonders if at some point that doesn't enter into the discussion more generally at the federal government level, but remains to be seen.
It's never been the practice of the U.S. to do that.
That's kind of the point, right? So, but I can also say I've had some conversations with some private sector actors who are looking to really expand their footprint in the storage space. And this is not anything that's imminent in the next 2 to 3 months, but longer term, I think what this crisis might actually unveil is a series of investments in storage that's more commercially oriented, because this is obviously an unprecedented event, but it's revealing some opportunities that could have been had that have not been able to be realized. So I think that's one of maybe the longer term ramifications of what we're living through right now. Along the lines of the outlook, another one of the questions that has come across in multiple forms has to do with demand. And this is more long-term than short-term, mind you. But as we sort of see economies around the world recover, first of all, I'd like to get both your thoughts on what that's going to take. But secondly, what you think it might mean with regard to the pace at which demand for oil recovers, much less all commodities and energy, and whether or not structurally the market will just be different post-COVID-19.
Well,
leave that one to you, Mark.
We're all epidemiologists these days, aren't we?
Right.
Look, nobody knows how this disease is going to progress. I mean, for me, it seems logical from the starting point that no one on the planet has an immunity because it's a new virus for our species. So it's going to have to work its way through the system or find a vaccine. And if it's work its way through the system, the only question is how fast. We're already seeing the debate being engaged here in the U.S. and around the world about what's the right pace at which to try to manage the spread of the virus, and how do you manage both the economic and the public health consequences of that. And so anybody who I've said this before in other contexts, but anybody who tells you they know how this will play out is making it up, because no one on the planet has ever seen it before. We'll have to wait and see. I mean, it's clear that the approach that the world has taken thus far has resulted in the sharpest economic downturn since the Great Depression and the biggest decline in oil demand that we've ever seen, with transportation obviously being a focus of a lot of these shelter-in-place, policies. So, where it goes forward from here, what I can say is that initially, I know a lot of macroeconomists I looked at thought it would be a short but deep recession, and I'm starting to see people starting to push that recovery off, and saying, well, it could be longer than we thought originally. But again, not my specific area of expertise. Do you want me to say a few words about the longer term too, Ken?
That would be great. Yeah, please.
I mean, again, no one knows for sure. We know that there have been, for example, in Europe, advocates for more aggressive action to deal with climate change have said, let's take advantage of this crisis to push stimulus, green stimulus. That hasn't been part of the policy set in Washington, D.C., nor as far as I can observe, in places like China. But is there potential for policies enacted through this to durably impact demand? Absolutely. And there's also questions around what it means for public concerns and preferences. Ken, you've noted that public transportation is a pretty dense way to travel. Will people be comfortable with that, while the virus is still live, and working its way through the population? And I think one other factor to consider is, given the massive stimulus that we're seeing here in the US and around the world, budgets will increasingly be more constrained in the future. That will limit the opportunity to engage in new policies that cost money. On the other hand, it will present a tempting target for new ideas for how to raise revenue, including potentially a carbon price.
Yeah.
So those would be my thoughts on how it shakes forward.
Yeah, I'll add just a couple of quick ones. So for the oil industry, I think it might demonstrate that, look, this industry is so dependent on transportation. It might look for another outlet for another demand source. So you might see some more investment in petchems, for example, or for companies that want to see less of this volatility, to have a greater stake in petchems or some other use of oil. I think the economic recovery is going to depend a bit on government policy, but it's also going to just depend on people voting with their feet and using.
Jim, you
Looks like,
seem to have frozen.
yeah, it looks like Jim froze. So we'll come back to him as soon as he can get back online. That's the reality of the world we live in right now.
But can it get it going again?
Yeah,
So
there you are, Jim.
So I mean, I think people will get out and travel, when they're ready. It's kind of hit home for me this week. I mean, a buddy of mine in New York, a guy I used to sit next to at work, just died from this, from COVID-19 last week, and he's 51. Guy's ran 83 marathons. I mean, he's a relentless marathoner. One of the healthiest people I know. He just really quickly got, he had been sick for a while, but then he got real sick and just died. So it's real, and stories like that people hear will probably temper their enthusiasm for getting back on planes and whatnot.
Okay. Yeah, so I think I'll just add to that. I think a lot of this script remains to be written, quite frankly. One of the biggest issues, and I had a conversation earlier today about this, in terms of dealing with demand recovery. It's not really just an oil specific issue. It's actually an economy-wide issue. Any commodity, any energy source, et cetera. I mean, we saw, for example, the dramatic reduction in demand impact the green energy space, with a reported reduction in jobs of 106,000 across the wind and solar industries in the United States alone. So this is something that's impacting everybody. And we can't forget that when we start talking about competitive balance across energy sources going forward. But it makes for an interesting debate in terms of policy, because in a lot of ways, if the government just throws all of its weight at abating fear, so this includes, more testing, not just for the virus, but potentially for antibodies, and thinking about the phased return to normalcy that has been, of course, denounced and left in the governor's hands around the country, in a way that will ultimately abate fear and allow demand and normal life to recover to any semblance of where it was before. At some point, you'll start to see demand build. But the degree to which that happens is entirely dependent on individuals' fear, right? I mean, and that's what makes this so remarkable, because it's different than anything we've ever experienced before. And so it makes it just rife with uncertainty. And I think you're seeing that, quite frankly, in a lot of the questions that a lot of people that are on this are asking, right? Sort of thinking about what a recovery looks like, what it means for specifically the U.S. oil patch. This is an interesting time, to say the least. One of the things I want to get both of your thoughts on real quickly is recovery in the U.S. in particular, what that might look like. Is there a historical benchmark we could use, perhaps, to understand how oil production in the U.S. might evolve over the next 6 months to 5 years, right? Because there's a lot of thinking about the near term, and rightfully so, but there's also a lot of thinking that's a little bit more strategic in nature, that's a little bit longer term. So I'd love to get your thoughts on that front.
Well, from my perspective, as always, the answer is it depends. And let me give you some historical comparison. In the last price war, the one OPEC did on purpose at the end of 2014, U.S. They at the time thought prices below $80 would wipe out U.S. production, and U.S. production responded. The rig count fell by 80%, and overall oil production in 2016 fell by a grand total of 400,000 barrels a day. Why was it not more? Productivity. You know, from the top to the bottom of the cycle, as the rig count was falling by 80%, productivity per rig went up by a factor of 150%, and the number of wells drilled per rig also went up by 50%. Now, you know, the question is, I think you could make the case that shale has become a more mature technology. In the last 12 months, productivity per well has only gone up by about 15%. And the number of wells drilled per rig has actually declined. You know, we're no longer seeing, you know, the big benefits from the move to pad drilling, for example. So, you know, one of the ways that the U.S. industry outcompeted OPEC in 2015, 16, 17 was, you know, to drive costs down. But the other way was to drive productivity through the roof. And the question is, you know, A, what is the scope for an industry that has already been operating on duct tape and paper clips, you know, in terms of cutting costs, and being, you know, having strained access to financing? Now will it be able to drive productivity gains as well, or not? It feels to me like, you know, while I mentioned we're already seeing a faster response on the way down this time than we did last time, feels to me like the downside is bigger, and the potential recovery is likely to be more constrained based on at least what we can see today.
Okay, Jim, I'm gonna kind of build on that response and get your thoughts on you know, potential implications for, you kind of dug into this a little bit, but for the geopolitical stance that countries like Saudi Arabia, for example, might take. And even we could get into relationships between U.S. China and U.S. Russia, and the sort of interesting pivot to Asia that's been occurring over the last decade. But how do you think you know, some of that perception about the ability of the U.S. oil patch to recover might actually impact the geopolitical spectrum, in particular with regard to the three countries that I just mentioned?
Well, it probably help it, right? So if the U.S. kind of resumes its dependence on importing oil and starts to view Saudi Arabia as you know, a more important to its energy security again, and you know, doesn't feel as independent, you know, from the kingdom, and doesn't, you know, doesn't seem to think it needs to take its, you know, Saudi views and you know, perceptions into mind when it you know, intervenes in the Middle East, for example. You know, from the Saudi perspective, that'd be probably a good thing. I think they would love to get back to that point. Is that possible? You know, I don't know. I mean, you know, the oil that's produced in the Gulf, you know, by the GCC, by Iran, by Iraq as well, that almost all of that now is flowing to Asia, to South and East Asia. You know, but you know, those countries are still the ones that we're allied with, are still dependent on us, on our hard security protection. So there's this kind of vacuum that's developed in the relationship where all of their economic life is facing east. They're increasingly economically intertwined. Even the laborers that are coming over to work in those economies are from, you know, from South Asia and East Asia, right? So they're, you know, they're just, you know, those cities are becoming, you know, as you go, those, you know, expat driven capitals in the Gulf they're looking more and more Asian. You see more and more Chinese restaurants, and, you know, North Korean labor gangs, and you know, the whole gamut, South Korean contractors building power plants or roads, or, you know, whatever. And so the, you know, the links with the U.S. are getting more and more tenuous, and they're looking to get, you know, beyond oil, find alternate rationales for preserving this strategic link with the United States. You know, and there's some interesting ones that are coming up, right? So Abu Dhabi is just about to start up the first of its 4 nuclear power plants. So it seems to it has chosen to avoid enriching its own uranium fuel for its plants, and it's importing it all from South Korea. South Korean contractor built those plants, but the risk of nuclear proliferation is still there. And I argue in a recent article that it's an alternate rationale for the U.S. to kind of protect the regime and to maintain security links with the UAE, because if there were some internal problems or if the government was overthrown, there's a proliferation risk there. Maybe might be a small one in civilian, but there. If Iran went nuclear, for example, beyond, if it developed a breakout capacity or even a bomb, those countries might see that as an opportunity to reinforce those ties with the U.S. Based on something beyond oil. So I think we may start seeing them steering the conversation that way, trying to keep that hard security protection until there's another option, which right now there isn't.
Thanks. Unfortunately, as last time, there's a ton of questions pouring in. I'm trying to kind of stay on theme. Hopefully we'll be able to address a few of these. Some are related to very specific regional issues that, in fact, on Venezuela, for example, were addressed in the webinar that we had last Friday with Francisco Minaldi and Mark Jones that really focused in on Latin America. So I encourage you to watch that archive. It was video archived on our website, so you can actually just tune into that and get some answers to those questions. Some of those questions, but and by all means stay tuned, because we will be revisiting these issues periodically as we go forward, because not to use a trite word, but the situation is certainly fluid. There's a lot of things that are changing in real time and bears a tremendous amount of attention, and of course that's what generates uncertainty. I would be remiss, though, right now not to address what has come up across the line in a couple of different ways with regard to the Texas Railroad Commission. The Railroad Commission had a hearing that was held Tuesday, just this last Tuesday, to consider the motion of pro-rationing production in the state. It was interesting, to say the least. There was a decent balance amongst all of the testimonies that were submitted and ultimately heard with regard to pro or con. But what appeared to me to be the case is, from the majority of producers who actually testified, either verbally or in written testimony, it looked to be that there was a genuine consensus against. That does not capture all producers. As a matter of fact, there was some notion raised in the hearing about small producers being exempted from any pro-rationing, but there was still support for pro-rationing. So it really, I think, paints an interesting picture about the oil patch in Texas, that the competitive balance is really shifted towards the larger, lower cost producers, and some of the smaller producers who maybe don't have fully long-term contracts for delivery and uptake, whose offtake agreements in some cases are undergoing some force majeure type abrogation. So the financial stress is not uniform, is the point, but without a doubt, every producer is feeling it. That was one thing that definitely came through in the hearing. That said, the commissioners were very open and honest about really addressing a couple of key points. One was, how do you define waste? Because under the current regulation, they can use pro-rationing to mitigate waste where they actually deem it to be occurring. And so we got into a lot of discussion in the hearing about waste in economic terms versus physical terms. And of course, that led to discussions about waste in the sense of flaring. And there were several testimonies that actually looked at or proposed using limiting licenses to flare as a means for mitigating oil production. Of Of course, that wouldn't really lead to a massive reduction in oil production, and that was something else that was also raised in the context of the conversation. But it was an interesting sort of sidebar that was raised multiple times in the hearing. But more generally, the commissioners all recognized that implementation would be difficult, which is actually one of the reasons why I don't think that you'll see any immediate move to establish or put pro-rationing in place. There was actually one testimony that was from an individual who was part of the Railroad Commission during his early days when they were still pro-rationing, so going all the way back to the early 1970s. And he made a comment, it was sort of off the cuff, half joking, half serious, when one of the commissioners asked if he could explain how it was done back then and how they might implement it now. He said, look, everybody that knew how to do it is dead. And the point of that comment was that it was 50 years ago, right? And so that does make it just logistically a difficult thing for the Railroad Commission to consider. And that's one thing that the commissioners were all very forthright with. They've been grappling with how to actually implement pro-rationing if they decide to move forward. It doesn't mean they won't come to some some mechanism that they can implement pro-rationing, but it makes it difficult. And quite frankly, it gets into this other issue, which is one of time inconsistency that economists like to talk about a lot. If you adopt a policy, but it takes time to implement it, does the issue go away before you actually implement the policy? And given that implementation of pro-rationing could actually take some time to occur because the mechanisms just aren't in place and the logistical knowledge is not in place to do that, according to what we heard in the hearing. It could be some time before, even if pro-rationing was implemented, it actually had a real physical impact on market balance. And quite frankly, it's highly likely that economics will dictate a lot of the types of production declines that were being discussed anyway. One of the things that was put on the table was a 20% prorate. So that basically means every well or every operator has to cut by 20%, regardless of where they are on the cost curve. And of course, that led to debate about whether or not that was appropriate, because you might be penalizing lower cost producers in favor of higher cost producers. And it was even revealed in the hearing that one of the things that had been discussed was allowing the pro-ration quotas to be traded, so that a higher cost producer could actually trade their quota to a lower cost producer. And I actually pointed out during my testimony that that would yield the same outcome that a competitive equilibrium would otherwise yield, namely the low cost producers would bid for those and the high cost producers would shut in anyway. So where that leads, I don't know, but it did not appear from what I saw in the hearing, which was incredibly long for those of you who watched it or didn't watch, but it lasted on the order of, I think, 12 hours. At the end of the day, I think it was difficult to really understand where the commissioners might ultimately land on this. But from what I saw, I don't think there's a high likelihood that you'll see any move to pro-ration in the immediate term. I think it's really more about letting economics do its thing. All that said, things can change. And with prices actually continuing on a downward trajectory and concerns about storage filling, that might actually accelerate actions that would have only been thought to be, a very, very low likelihood of occurring as we move forward. So I think it's one of those things, kind of as Mark said, is the answer depends, right? It does depend. It depends a lot on the various pressures that are being felt across the market. So there were, during the hearing, there were lots of discussions as well about the potential for well damage, reservoir damage, et cetera. The people who were on that, who were involved in that discussion are all on the operational side or in the reservoir engineering space. And there was really no indication that that's at least communicated through testimony that that's a concern that is valid. So of course, again, it's well by well. And these are actually expensive assets. So each operator would have to actually step up and talk about that individually. But the general theme that came through in the testimony was that that's not really the biggest issue.
Can I just add one thing to that, Ken?
Yeah, absolutely, Mark. Go ahead.
And this is a shameless plug, I'll freely admit, but I have to say, personally, while there was a lot of talk about potential job loss as well as company failure, you were the only person that I heard, at least in the big portions of it that I listened to, that talked about the social safety net, and one dimension of this being the need to look after workers and their families, when the inevitable job losses do occur.
Yeah, I mean, that's actually, thank you, Mark. That's actually a point I raised, and Mark, you and I talked about it, and it's in the written testimony as well. But the idea that, because there were a lot of concerns raised during various testimonies about workforce deterioration, and how some of these people, when the sector actually turns, will not come back to the sector. I think you heard similar comments going back to 2016, of course, not in the context of a Railroad Commission hearing, but certainly people did say it when we got down into the mid-20s and early 2016. But I don't think that's what we've seen since. But certainly, in order to sort of help during these extraordinary times, the workforce sort of weather this storm, so that the Texas oil and gas sector can be responsive once the tide does turn. That's where social safety nets and other government policies that are really outside the purview of the Railroad Commission, but very much in play in the context of this discussion, are well worth the attention. So yeah, absolutely. And there was no argument with that statement, by the way. So I think a lot of people do realize that there's value in those types of policy remedies, or potential policy remedies. And I will say one interesting thing that did come out of the hearing. There was a lot of discussion about some things we've talked about today: potential for coordinated response across states and across the federal government, because there were some proponents of pro-rationing in the state of Texas that said only if other states do it too. Which then begged the question, and the commissioners were very pointed in asking this question: does that mean we should reach out and try to coordinate with other state agencies? And of course, the respondents to that question never gave a straight answer. There was a lot of waffling, but it did raise the specter of will that actually be something that we see occur? And personally, I don't think so. But it was something that was raised, and it was something that has obviously been considered. Of course, a 1 million barrel a day cut in the state of Texas, if it doesn't happen anywhere else, is not really going to amount to anything, given the depth which demand's been destroyed in the near term. So yes, it buys a little bit more time, but it doesn't really move the needle in terms of price and the economic reality that we're faced with today. So thinking about how coordinated production response might evolve going forward is something that we're going to have to keep our eye on, just to be blunt. So we are unfortunately up against it on time. I'd like to actually ask Mark and Jim to make maybe one more final comment. There are a number of questions that have come through that, again, we have not been able to get to. But I can almost assure you that we'll probably be back at this again in 2 weeks, because there's going to be a lot change over the next 2 weeks. In fact, my understanding is that the April 21st meeting, so that's next Tuesday, of the Railroad Commission, they're going to actually be talking about whether or not to implement pro-rationing. So we'll see what happens there. And there'll certainly be a lot to talk about in terms of what transpires between now and then. So first, I'll start with you, Mark, and then hand it over to you, Jim. So Mark.
All right. Hi. I guess what I would say, there was actually a couple of comments coming in, as we were speaking, saying, yeah, but as rigs get laid down, don't forget that the most productive crews, will be the ones left. The most productive rigs will be the ones that left. The most productive companies that will be the ones that are left. And yes, absolutely. And in fact, just like to go back to my my opening comment, about how Houston, we have a problem, but like 50 years ago today, we'll get through this one as well. We will get through it because of the ingenuity and creativity and hard work of the people on this call and the companies that you work for. And don't forget that. Trust it. Rely on it, because it is the most powerful force out there.
Wow. Well, Tough act to follow always, Mark. It's some
Sorry.
inspirational comments. Mine are probably less inspirational, but I hope interesting. So one of the things that I'm going to be following, and I think that could have some interesting potential, is the G20 meeting. Actually, that Mark and I and Ken are all involved in. So Saudi Arabia is the head of the G20. Actually, the Baker Institute is a partner think tank in preparing some policy briefs that we've been working on. I think this is it's almost like hosting the Olympics from a geopolitical standpoint, and I think that's how Saudi's taking it. They are using this to really reach out beyond the United States to build up their geopolitical relationships and their stature around the world, to show some global leadership and hopefully some magnanimity. And we'll see that maybe, hopefully, it'll it'll be part of their domestic policy making. We may see hopefully a little less impulsive decision making, and it also looks like it may be helping to wrap up the war in Yemen. I think this disastrous war in Yemen, Saudis just declared a unilateral ceasefire, and peace talks have been ongoing in Oman. So, I think it would be pretty tough for the Saudis to host this big summit in Riyadh without, while actually fighting a hot war in Yemen right next door. So, some hopefully some positivity coming out of that. It'll be interesting to watch for sure. Thanks for having us.
Yeah.
It's great chatting with you all.
Great. Thanks, Jim. Thanks, Mark. And thanks for everybody that tuned in, and stay tuned to everything we're doing, because we are addressing things in real time. Please continue to check our website for updates and publications to address some of the issues and questions that all of you seem to have. Some of them are very specific to particular commercial interests. Sorry we couldn't necessarily get to those specifically. But if you have a burning follow-up question, feel free to reach out directly. Happy to do that. All right. Thanks again for everybody, and stay safe and healthy.
All right. Good weekend, everybody.